here we are, closed the year at 1,400. Now it's back over gold. So what do you think about that?
I guess you got to call it a perfect storm. You got all the wonderful news information that's hitting the market is more positive for platinum than any of the other precious metals. You've got situations where you had a major strike at one of the biggest mines in South Africa where they weren't producing platinum. That cost the market about 100,000 ounces. You've got issues in regard to possible nationalization of mines in South Africa. There's a lot of talk about some of the parties in South Africa are talking about the nationalization of the mines. You've got increased demand because of the auto production. And at the same time, you just announced this recently was the Royal Canadian Mint. They announced that they were going to be starting to make platinum maple leafs again, and they haven't made them for over a year, and now they're going to start making them again, and they'll start marketing them. So that's a great platinum investment product is the maple leaf.
Right, I saw that, and that's definitely going to take up some demand, and it's going to use supply that really isn't there. We're in a deficit for supply for this year. Yeah,
that's all the figures out of the various analysts say that there's going to be at least 130,000 to 180,000 ounces shortage this year. That's major with platinum. It may not necessarily affect that much, wouldn't affect gold, but on a platinum. Because there's no really above-ground supplies of platinum like there is in central banks of gold around the country. So that big of a shortage could probably take platinum up substantially. You have to realize just recently here, platinum was trading at a $200 discount to gold, and now it's trading at a premium to gold, and that's over a period of about a month to two. So you're seeing the best performer of all the metals to be platinum right now. And from just a diversification point of view, if you're a precious metal holder, you've got to own platinum.
It makes sense, and it's only about a 6 million ounce market. So when you talk about a deficit, 180,000 ounces, and who knows how many ounces the Canadian Mint is going to sell,
right?
It could really, it could just take off at a moment's notice.
Auto production's up, and as your listeners may know, that platinum is the key component in catalytic converters for automobiles. So if the automobile market starts picking up, that's more platinum going into those catalytic converters.
Yeah, and they haven't figured out any other way to take the pollution out of the tailpipe but the catalytic converter, which is the primary consumer of platinum produced in the world. It's just amazing to me.
Aerospace, there's a lot of high-tech reasons for platinum, but the main consumers are obviously investment demand, jewelry, the Japanese love platinum jewelry, and catalytic converters. As the Japanese market comes back, they were major sellers after the earthquake and tsunami. They were major sellers, obviously, to get them back up on their feet. Now all of a sudden the economy's coming together. There's a lot of stimulus in Japan, and platinum market's starting to get active again.
Yeah. Yep. Well, what about gold? What do you see happening there, Barry?
Gold got the volatility this year. And obviously late last year, I was saying to you a little bit earlier that I monitor gold, I'd say, on at least an hourly basis, if not more. And when you look at this much action in there, and you see this much trading on the exchanges around the world, I'm talking from Singapore to London to New York and back to Australia, and again, you're monitoring this around the world. You're seeing a lot of volatility, and at certain price points, major buying comes in, and that's what I expect to see tonight, as we get to Asia, because of the sell-off today. We had about a $50 sell-off in gold today, which is all in reaction to the Bernanke talk and no QE2 and stock market getting QE3. I'm sorry, and the stock market getting rallying and the dollar being a lot stronger. So you're seeing a sell-off in gold, and at some point here you're going to see a buyer step up, and it's happened every time over the last couple of years. A major buyer comes into the market and buys 50 metric tons at a particular price, and then it rallies back up again. So there's buyers out there, and a lot of the Asian markets are price buyers. They love to buy, obviously, at a low price. So I expect that you'll see gold maybe trade here for a short period of time, maybe get down as low as 1,600. I doubt if it will break 1,600, but because there'd be a tremendous amount of support at 1,598 or something like that. So But at that point, maybe it will just base for a while and then just work its way up. But a lot of these commodity houses, a lot of the professionals in gold trading know how to manipulate and take the weak hands out. Many small investors may buy a contract or may buy spec on an option, and they're really very vulnerable to the traders and the professionals. So I'd say any of your listeners who do participate in the contract market or buy on margin or buy the options, just be more conservative. Just buy it, put it away in the vault. You got it. It's not, nobody's going to take it from you, and you're not subject to this volatility, because this volatility is going to get a lot worse.
Yeah.
I think in the next year or so, you're going to start seeing $50, $100 up down days as a common occurrence. But at the same time, you're going to see a rally probably up substantially. I mean, I do look for gold to reach over 2,000 this year and 2,400 next year. So you're going to, when you start making moves of that size, a $100 move up and down may only represent a 5% move, but it's still, considering what we've had in the past, going to be a lot of volatility there.
Yeah, there's 2 points I wanted to make. Number one is that for people who are not professionals to get involved in any commodities trading is almost a surefire prescription to lose all your money. I've done it a few times, and with the same results each time, because I'm not a professional and I'm going up against professionals, and every trade on the commodities exchanges, there's a winner and there's a loser, and guess who the loser is going to be? It's going to be you if you don't really follow it and effectively become a professional. It's always worked the same way with options with me in anything as well, because options traders are not the people trading stocks, and they know how to get you. And the fact is that just buy the physical, forget about the exchanges, even though the leverage is appealing and how much you could possibly make. But unless you really got some inside edge, you're going to lose there every time. I mean, right?
Oh, I've seen this happen again and again. Clients of mine who have purchased precious metals and put it aside, and they call me up and they say, well, I'm long 3D contracts, and I've got my stop losses in the X. You have to realize every time you put in your stop losses or something like that, that's exposed to the trader. It's like playing with your cards showing, and it's very scary because they're small traders. I mean, they're not over margin. They get hit with a margin call. They sell to get out. Most of these professionals are posting T-bills. They don't have to worry about margin calls. They've got a strong financial position. And as people panic out at the wrong time, they're buyers. And as people are panicking in, they're sellers, because they know they're going to take it down at some point and make the correction and pick it up.
Yeah, it's totally stacked.
Yeah,
totally.
Yeah, that's why. Don't do it. I mean, if you want to get a seat on commodities exchange and be there all the time, or be like me, where I'm watching gold on a minute-to-minute basis, where I'm actually connected to the floor and I'm watching the volume of trades going in and out, and then that's a career, but it's not an investment.
Yeah, and if you want to gamble, go to the casino. You're going to lose there anyway.
At least you get free drinks.
Yeah, you might get free drinks. You might even wind up with a free meal and a nice room for your efforts.
Now you're talking.
But, hey, when you talk about you're watching the trades go in and out,
yeah.
Last week when gold and silver really got slammed, did you watch that huge volume just dump?
Yeah, I was on the phone trying to figure out who did it.
Yeah, well, it's kind of obvious who did it, huh?
Yeah, well, we kind of figured out, but you need to confirm. You know what I'm saying?
Yeah, well, I'd venture to say that it was probably a highly connected banker that dumped it as well. But that was a pure dump, right? Yeah,
it was a sell-off to take advantage of the move to take out the. There's a lot of people that chart it, and they follow trend lines and support lines, and at certain levels they execute sell orders. It's like I know if I'm a major banking house or a major commodity house, and I've got a book showing where all my clients have their trade orders at and where they've got their stop losses out, I know what I can take it down to execute, buy it back up.
Yeah. Oh yeah. Like you say, it's like showing your cards, and then expecting to win the hand, and it can't be done. It's kind of distressing because it ties in with that letter to the editor of the New York Times from the guy who quit Goldman Sachs today, where they call the clients Muppets and God knows what else they call them, and it just becomes an exercise in separating clients from their money.
Yeah, you're looking at a situation. I'd like to think that Goldman has more class than that, but I'm not saying that this guy's wrong. I don't know. I'm not that well connected. Do I have some clients that work at Goldman? Yes. However, how they deal with their clients and particularly their institutional basis, I'd like to think that they're more positive, but this letter's got a lot of credibility to it.
Yeah, it certainly is enough to bring up the discussion and make you think about it. And that goes in with the whole things trading commodities. You know, they've got your high and they've got your low. They know when they can chase you out of the market, and they've got access to it. And they had that black box for a while, where maybe they still have it, where they could see everybody else's trades a second or a nanosecond before they were executed, and they could rush in there and front end them. And when you see that kind of thing, it really makes the little guy think, hey, I've got to figure out another way of doing it. And the only way I think I'd ever think about getting involved in commodities is you look at something like natural gas. It's trading at $2.50. You have to think, how much lower can it go? And if you've got T-bills and you can just keep rolling those contracts over and wait a year or two for when it makes its move.
Wouldn't you be better off playing like a Chesapeake or something like that?
Yeah.
Where you've actually got the equity. I think they pay a small dividend.
Yeah, you get a dividend. Sure, yeah, you're right.
And you don't have to be worrying about somebody hitting you with a margin call. And that's a pure natural gas play. I mean, so you've got the option. I'd rather, I don't mean to disagree with you, but I'd rather play that than the contract market.
Oh, I see your point. Believe me. But when you've got like an undervalued commodity that's so undervalued, because look, a barrel of oil should be trading 6 times MCF of natural gas, and now we're at close to 50, and that's just insanity. But yeah, you're right. You got safer ways to play the eventual move than going into that den of thieves or that shark tank.
I've seen it. I've had lunch with commodity brokers. I've sat down at dinners where they're comparing their books to where they have their stops and whatever. And I did this a number of years ago. We're talking like 25 years ago. I went to a lunch place, like a bar right around where the commodity options were being traded in Chicago, and they're sitting there all books wide open, saying, "Well, where do you got your stops at? Okay, where you got your okay, that's good. So we take this down. Yeah, we could execute these, and these would sell." And I'm saying, "Oh my God, this has got to be illegal." I mean, first of all, it is illegal.
Yeah.
But in terms of enforcement, 25 years ago, it wasn't there. Now, at least they've got enforcement. They're far more secure in terms of the way they do things like this.
Yeah, theoretically, but yeah, it has to be. Now it's done with the computers, not with guys over lunch. Yeah. So it's harder to track, but it's the same game. Anyway, Barry, where do we find you on the internet?
Well, I'm on Stuppler.com, and we have prices. We have a e-commerce website that provides not only prices of all the various gold and silver items with the spot price of gold, but I do post a daily blog up there, which is a daily information. We post a weekly market report, which is up there, and we have a lot of news articles that are coming out and opinions that are up on under our investor education section on the website there. So we get a lot of viewers that come every day just to read the daily quote and the weekly market letter, which goes out to all of our clients. And a lot of it has to do with not just gold and silver, obviously, with platinum, with the rare coin market, what's happening around the world that affects those things. So I spend a little time writing every day, so can I tell you it's fun.
Yeah, hey, I know you put a lot of work into it, and I totally enjoy reading it, especially your reports. They're so comprehensive, and you've nailed the market virtually every time that I've read one of those. So
sometimes you need a little luck, but I think the general trend is going the right direction. I think you're seeing. I mean, you may get these ups and downs on this high volatility issue, but in terms of the general trend, over the last 11 years have proved that gold and silver are the best investment